Hello, my name is Edmond Jamna, and on behalf of DW Consult, I want to welcome you to Tutorials on the Go. Our zeal here is to help transition people with zero, struggling, or shaky base in accounting to an expert position and to a place of confidence. It is also a platform to assist in the smooth studying of the ACCA and ICA professional qualifications, as well as for any tertiary accounting discipline. All that is required of you is to subscribe to our channel and click on the notification bell as well to be part of the program. Tutorials on the Go, bringing accounting to heart. Now, to this episode's lecture. Intragroup transactions, consolidated statement of profit or loss. So we first look at certain basic principles. Now, intragroup transactions must be eliminated from the consolidated statement of profit or loss. Let's first look at sales and purchases. Now, when the parties to a group trade in goods among themselves, say P sells to S, the seller P will record the transaction amount as revenue and the buyer S as cost of sales. Now, these figures must be eliminated as the group perceived as a unit can never trade with itself. Hence, consolidated sales revenue will be the parent's revenue plus the subsidiary's revenue less the intragroup sales. Okay, the transaction amount, the total of it is what we less. Now we come to the consolidated cost of sales. That will also be the parent's cost of sales plus that of the subsidiary less the intragroup sales, the same figure. Okay. Now, if the transaction was made on credit, any amount outstanding must be eliminated from the group's current account, that is the receivables and payables, and the consolidated statement of financial position, as already discussed in the lecture with a link above. Now, if some of the goods remain at the date of consolidation, the unrealized profit must be removed by being added to the cost of sales of the seller, thereby reducing the gross profits. The next principle we'll talk about is transfer of non-current assets. Now, when an asset of a non-current nature is transferred within the group, any profit or loss arising on the transfer must be deducted. Secondly, the depreciation must be adjusted to reflect the cost of the asset to the group. Now, this is important because the buyer, who is the new owner, will be calculating the annual depreciation charge on the selling price, which is higher than the cost that the parent has. Management fees. Now, any fees of such paid must be deducted from the income of the receiver's account and the expense of the payer's account. Lastly, fair value adjustment. When the fair value of the net asset of the subsidiary is more than its current value, it will lead to an increment in the depreciation charge, as the non-current asset will require an adjustment. Now, the additional annual depreciation must be added through the cost of sales in the subsidiaries column. Okay, let's test our understanding. Garrett purchased 85% of Nathan on 1st January 2015. Statement of profit or loss for the year ended 31st December 2015 are as follows. So revenue for both are stated here: cost of sales, gross profit, operating expenses, profits from operations, finance cost, profits before tax, income tax expense, then profits for the year. Now, in additional information, during the year, Nathan sold 50 million goods to Gary at a markup of 20% on cost. Now, 1/4 of those goods are in inventory at the year end. So we have to prepare the Garrett Group consolidated statement of profit or loss for the year ended 31st December 2015. Now, in solution, consolidated statement of profit or loss, we have revenue of 150 million for Jane, as in Garrett, 80 million for N. The adjustment, that is the amount of goods that N sold to Jane, we less it. Then the group will have a figure of $215 million. For cost of sales, we pick that of Jane, which is 70 million. We pick that of N, which is 30 million. Then we also less it because the cost of sales is now being reduced from the revenue. To reduce it, we add. Okay, simple mathematics. When you have a negative and you want to reduce, you add. Then a group figure for cost of sales will be $85,000. Now, when we come to the unrealized profits, that is the profit on the amount unsold at the year end. The markup percentage was provided. That is the percentage supposed to be calculated on the cost. But then the selling price was rather provided. So it will be the 20 on 120 times the amount that is outstanding, which is 1/4 of the 15,000. Okay. So it will be 625,000. The cost, the subsidiary N, was the one selling. The profit was attributable to him. So we less it from his account. We less the same from the group section. Then gross profit will be 80 million for Jane, $49,375,000 for N. The group profit will be $129,375,000. Come to operating expenses, $30 million for J, $25 million for N. Group expenses will be $19,500,000. Profit from operation will be $50 million for J, $24,375,000 for N. Group will be $74,375,000. We come to finance costs. Here, there was no mention of any intra-group transaction relating to maybe loans given and interest being paid or management fees present. So these figures were paid to outside members. So everything is captured here. So it's $5 million for J, $1 million for N, 6 for the group. Profit before tax is $45 million for J, $23,375,000 for N, then $68,375,000 for the group. Income tax is $50 million for J, $30 million for N, $28 million for the group. Then profit for the year will be $13 million for J, $10,375,000 for N, then $40,375,000 for the group. And we come to the profit attribution. We just migrate the profits for the year to this page to make things simpler. So I first find the profit to be attributable to the non-controlling interest. Because Garrett held 85%, automatically the 15% will be NCI. So we multiply that on the profit of the subsidiary, which is $10,375,000. It will lead to a figure of $1,556,000. Then the amount to be given to the parent will be the difference between the group profit for the year and that's being given to the NCI, which will be $38,819,000. Let's test our understanding again. Preston P acquired 70% of the share capital of Shelley S on that company's incorporation on 1st January 2018. Now, the respective statement of profit or loss of the two companies for the year ended 31st December 2018 are as follows. So we have revenue for both P and S, cost of sales, gross profit, expenses, profit before taxation, tax, profit for the year. Now, in additional information, the fair value of a non-current asset of Shelley exceeded its carrying value by $5,000. Now, the asset had a remaining useful life of 5 years. So on 1st January 2018, Preston sold the machine with a net book value of $30,000 to Shelley for $32,000. So group policy dictates that the machine is depreciated over its remaining useful life of 5 years. So we have to prepare the consolidated statement of profit or loss for the Preston Group for the year ended 31st December 2018. So for solution, consolidated statement of profit or loss, the revenue will be that of P, 62,000, 34,000 for Shelley, the 96,000 for the group. There is no intra-group transaction here, so we didn't bring the adjustment column to do away with the sales and the cost of sales. Okay, so we come to cost of sales: 22,000 for P, 14,000 for S, 36,000 for the group. Then we have fair value adjustment. Okay, the depreciation arising out of that, it's $1,000, and because it is the subsidiary's assets that require the adjustment, we put it under that column. We'll show the workings right after this page. So the group also recorded $1,000 amount. When we come to gross profit, it's $40,000 for P, $19,000 for S, $59,000 for the group. So expenses will be $12,000 for P, $6,000 for S, $18,000 for the group. We come to profit on disposal, the asset that was sold to S. Because there was a profit, P recorded it in its account, so we less it, $2,000. We'll show the workings also very soon. Then we come to the depreciation. Okay, the additional depreciation that was recorded because of the new owner, which is S, having it at a higher cost. Okay, so we are adding the 400 because the depreciation was negating the gross profit. So in order to reduce it, we add. Then we come to the profit before taxation, which is 26,000 for P, 13,400 for S, 39,400 for the group. Then we come to tax: 13,000 for P, $4,000 for S, 17,000 for the group. Profit for the year will be 13,000 for P, 9,400 for S, 22,400 for the group. When we come to the profit attribution, we bring the profit for the year here. First deal with the non-controlling interest first. Here they had 30% stake multiplied on the 9,400 profit for the year for the subsidiary. It will be 2,820. Then the balancing figure will be $18,720, which is the difference between the profit for the year for the group and that's attributable to the NCI. Now, when we come to the workings, the first we'll show is the fair value additional depreciation, which is $1,000, arrived at dividing the fair value amount, $5,000, by the number of useful life left, 5 years. When we come to the profit on disposal, it was $2,000 as a result of finding the difference between the transfer price of $32,000 and the current value of $30,000. Then we find the depreciation adjustment, which was $400. That was arrived by finding the annual depreciation of the profit on disposal. So folks, this is where we draw out the curtains on our lecture. If you have any comment or feedback for us, do well to drop them in the comment section below, and it will be timely and adequately addressed. Whilst at that, kindly subscribe and turn on all notifications to stay abreast with our uploads. Also, follow us on our various social media handles as captured on the screen. So we come to you by way of another episode of Tutorials on the Go. Take care of yourself and stay blessed. Poker.